welcome to this explainer. Today, we're breaking down the absolute ultimate framework for starting your journey in trading. If you've ever looked at a chart and just felt completely overwhelmed, trust me, you are not alone. So many beginners end up wasting years of their lives and literally thousands of dollars just kind of stumbling through the dark. But it really doesn't have to be that way. By building a proper, structured foundation in trading, we can totally bypass all that confusion. We're going to distill years of hard-earned experience into a clear, super simplified path for you.
Okay, let's dive into this. Here is our roadmap for today. First, foundations in trading. Then, tools of the trade, followed by the psychology of risk, reading the charts, and finally, testing your strategy.
So, let's kick things off with Section 1, Foundations in Trading.
Right off the bat, there is a stark contrast between traditional investing and day trading. In traditional investing, you might park your money in the broader market and wait an entire year just to see maybe a 10 to 30% gain. And hey, that's great if you have massive capital. But day trading? It allows you to zoom right in on individual days. With the right setup in trading, just $100 of calculated risk on a single intraday move could actually yield a $341 profit in a matter of hours. Pretty wild, right?
Now, you might be wondering, where do those intraday opportunities actually come from? Well, they come from volatility, drastic price moves caused by imbalances in supply and demand. Deep down, a chart is really just a visual representation of mass human psychology. Think about it. When demand from buyers outweighs the supply from sellers, the price goes up. When sellers take over, it corrects downwards. That constant tug of war? That creates the exact volatility we need to trade.
Moving right along to Section 2, Tools of the Trade.
Look, you do not need a dozen expensive monitors to be successful in trading. Honestly, you really just need 3 basic necessities. First up is TradingView. That's going to be your home base for all your charting and analysis. Second, you need a broker to actually execute your trades. Platforms like Bluefin, Bybit, or TopStep are great for this. And finally, and actually, this might be the most important one, a trade journal to track your data.
Beginners often start out with a basic line chart, but day traders, we rely almost exclusively on candle charts because they just give you so much more data. See, a green candle means the price opened lower and closed higher, while a red candle means it opened high and closed lower. And those little lines on the top and bottom, the wicks, they show you the absolute highest and lowest prices reached during that time. By setting your chart to, say, 5-minute increments, every single candle tells the complete story of that battle between buyers and sellers.
All right, let's get into Section 3, the psychology of risk. This is a big one. As humans, we are totally wired to believe that losing is inherently bad, right? We think making money means we made a good decision. Well, in trading, you have to completely flip this on its head. Losing is not inherently bad. It is simply an opportunity cost to get into the market. You just have to accept that you will be wrong sometimes, and that is perfectly okay. Success in trading is strictly about following a repeatable process while keeping your risk absolutely contained.
And this brilliantly illustrates exactly why you do not need to be perfect to be highly profitable. Imagine you take 10 trades, risking exactly $100 on each one. Say you are wrong 70% of the time, so you lose 7 out of 10 trades. That's a loss of $700. But when you win those remaining 3 trades, you let your profits run, making multiples of your initial risk. That yields over $1,000. The result? Despite being wrong 70% of the time, you still walk away with a net profit of $380. That, my friends, is the absolute magic of risk management. But wait, how do you actually maximize these controlled risks if you only have a small account? The answer is leverage. A 10x leverage multiplier acts like a magnifying glass. It allows you to control a much larger position than your account balance would normally permit. So if you spot a setup requiring $6,800, 10x leverage means you only have to put up about $680 of your own capital. It gives you the upside of a large account, provided, and this is absolutely crucial, provided your risk is strictly managed.
Okay, moving to Section 4, reading the charts. The very first thing we look for on any chart is a trend. Trends are essentially these invisible levels of supply and demand where the price repeatedly bounces or eventually breaks. By drawing a line connecting the lowest points of a price movement, you can clearly identify an uptrend. If the price keeps respecting and bouncing off that line, well, the trend is intact. But once it breaks below that line, the psychology has shifted and a downtrend often begins. Identifying these trends tells us exactly where the price is likely to react next.
To get even more precise, we use an awesome tool called the Fibonacci retracement, When a market is trending upwards, it rarely moves in a perfect straight line, right? It pulls back. The Fibonacci tool highlights natural mathematical ratios where these pullbacks actually tend to stop. The most critical level is the 61.8 ratio, often called the golden ratio. It's actually fascinating. This ratio occurs naturally in tree branches, seashells, even human facial symmetry, and it appears just as reliably in trading. Very often, a pulling back price will cleanly bounce right off the 61.8 level before continuing its overall trend higher.
Another incredibly powerful concept in trading is the fair value gap. This usually happens during really explosive moves and consists of a specific three-candle pattern. You spot it when the wicks of the first and third candles do not overlap at all, leaving this gap in the body of the second candle. Because the market always seeks balance, price acts almost like a magnet here. It will frequently pull back right into the midpoint of a fair value gap just to fill that imbalance, which gives us a textbook entry point to ride the trend.
And finally, Section 5, Testing Your Strategy.
Listen to me on this one. You should never, ever dive in with real money right away. You need to follow this strict progression. First, observe the concepts. Second, create a strict set of rules for your setup. Third, evaluate the mathematical outcomes. And finally, test it. TradingView has this incredible bar replay feature where you can literally rewind the chart to a random day and just hit play. Practice spotting those trends, those Fibonacci levels, and fair value gaps in real time. Only when you prove your strategy works there do you move to a simulated account, and then, and only then, real capital.
Well, we've reached the end of this explainer. You now have the foundational math and you understand the technical tools. But ask yourself this, do you actually have the psychological discipline to execute this process without emotion? Remember, success in trading is absolutely not about ego, and it's not about being right. It is about disciplined execution, managing your risk on every single trade, and letting the probabilities work in your favor over time. Master your mindset, and the market opens up a whole world of opportunity. So, what's your next move going to be?